the moment momentum forgot itself. Momentum didn't fail loudly. It hesitated, and in that hesitation, the market lost something it relied on for far longer than anyone realized. To understand why this moment matters, we need to return to a time when momentum felt dependable, trends extended cleanly, pullbacks were brief, direction rewarded conviction. Acting in line with movement felt logical, even responsible. For years, momentum wasn't just a strategy, it was an assumption. Momentum works when belief is shared. When enough participants trust that movement will continue, price becomes self-reinforcing. Buyers buy because others will buy. Sellers sell because others will sell. Direction feeds on confidence, and confidence feeds on participation. The first reveal begins when that feedback loop weakens. Trends still existed, but they didn't feel as persuasive. Breakouts occurred, then stalled. Follow-through faded. Moves required explanation instead of trust. Momentum hadn't disappeared, but it had lost authority. The second reveal appeared in behavior. Participants still followed trends, but with tighter exits. Positions were held lightly. Gains were taken quickly. Momentum was no longer something to lean into. It was something to manage carefully. The strategy remained, but belief in it softened. The third reveal emerged when momentum signals conflicted. Indicators pointed forward, but price hesitated. Strength appeared, then dissolved. Traders waited for confirmation that never fully arrived. Momentum was present, but it felt uncertain of itself. That was the moment momentum forgot its role. Not because trends reversed, not because volatility exploded, but because fewer participants trusted momentum to carry them once they committed. The market still moved, but it no longer moved with agreement. And when momentum loses agreement, it stops being a force. It becomes a question. What followed would reveal how quickly markets change when the engine that once powered direction begins to doubt itself, and why the absence of momentum is often felt before it is seen. As momentum lost authority, the market began behaving in ways that felt strangely unfamiliar. Moves still developed, but they lacked persistence. Each advance required more participation than before, and even then, follow-through felt thin. Momentum no longer pulled capital forward. It asked to be trusted. The conflict emerged when participants stopped reinforcing trends automatically. In the past, strength invited strength. Now, strength invited scrutiny. Buyers hesitated at levels where they once accelerated. Sellers tested rallies instead of retreating. Momentum signals fired, but response was selective. Liquidity reflected the shift immediately. Depth appeared, but it didn't chase direction. Capital waited for confirmation instead of creating it. Support arrived late. Resistance formed early. The market was no longer cooperating with momentum. It was negotiating with it. The tension deepened as its behavior repeated. Each stall breakout trained participants to take profits faster next time. Each failed extension reduced belief further. Momentum didn't collapse. It eroded through disappointment. And disappointment spreads quietly. Institutional desks adjusted accordingly. Trend-following exposure was reduced incrementally. Risk was reallocated toward strategies that didn't depend on continuation. Momentum remained part of the toolkit, but it was no longer trusted to lead. Derivatives markets confirmed the change subtly. Skew flattened. Demand for protection increased even as volatility stayed contained. Traders weren't betting against trends. They were hedging the possibility that trends would fail to extend. The buildup accelerated when correlations tightened. Assets that once moved independently began responding to the same signals. Momentum strategies synchronized. When they failed together, they amplified stagnation instead of movement. Veteran participants recognized the warning signs clearly. Momentum doesn't stop working suddenly. It stops working when belief stops reinforcing it. Once enough participants hesitate, momentum becomes fragile, no matter what indicators suggest. The market was still trending, but it was trending without confidence. And confidence is what turns movement into direction. The next phase would reveal what happens when momentum is tested by uncertainty, and whether it can reassert itself once participants stop trusting it to do the heavy lifting. That test arrived when uncertainty entered a market that no longer trusted momentum to carry it through. Not a shock, not a reversal, Just enough ambiguity to ask a simple question. Will the trend hold without encouragement? The answer was hesitation. Prices pushed forward, then slowed. Momentum signals remained active, but participation thinned. Buyers followed, then stepped aside. Sellers didn't rush in, but they didn't retreat either. The market moved forward on habit, not belief. The conflict intensified as this pattern repeated. Each attempt to extend met resistance sooner. Each pullback recovered less cleanly. Momentum was still visible, but it felt fragile, like a suggestion rather than command. Participants no longer assumed continuation. They demanded proof. Liquidity exposed a strain clearly. Depth existed, but it didn't align with direction. Capital appeared after moves, not before them. Support formed only once trends weakened. Momentum had lost its ability to attract proactive participation. Institutional systems responded predictably. Algorithms reduced position size. Trend-following strategies shortened holding periods. Risk controls tightened not because losses mounted, but because conviction was gone. Momentum without belief became something to manage, not trust. The buildup accelerated as correlations tightened across momentum-driven assets. When trends faltered, they faltered together. Diversification weakened. Strategies that once offset each other now shared the same vulnerability. The absence of follow-through. Veteran participants recognized the danger immediately. Momentum isn't just speed, it's agreement. When agreement fades, movement becomes unstable. Trends can still exist, but they lack the reinforcement needed to survive uncertainty. As pressure persisted, momentum signals began failing quietly. Breakout stalled. Continuations reversed. Not violently, but consistently enough to change behavior. Participants stopped leaning into strength. They started fading it. That shift marked the real turning point. Momentum hadn't reversed. It had lost trust. And once trust is gone, the market no longer moves because it believes. It moves because it hasn't yet accepted that belief is missing. The final phase will reveal what happens when momentum, stripped of confidence, finally confront a moment it cannot push through, and how quickly direction changes when the engine of continuation forgets how to lead. The moment arrived quietly, but its impact was unmistakable. Momentum faced a situation it could no longer push through. A stretch of uncertainty lingered just long enough to expose what had been missing all along. Without belief to reinforce it, direction weakened on its own. That was the climax. Momentum didn't collapse. It disengaged. Prices stopped responding to signals that once felt automatic. Strength no longer attracted follow-through. Weakness no longer resolved quickly. The market didn't reverse violently. It lost coherence. Moves became choppy, uneven, and unreliable. Momentum had forgotten how to lead because no one was willing to follow without proof. What shocked many participants was how logical it felt in hindsight. Momentum had relied on shared trust for years. Once that trust faded, continuation required effort instead of assumption, and effort in markets is rarely sustained without reward. Liquidity adapted immediately. Capital no longer chased movement. It waited for resolution. Support appeared only after trends failed. Resistance formed earlier than expected. The market wasn't fighting momentum, it was ignoring it. As the adjustment unfolded, the resolution came into focus. Participants stopped treating momentum as an engine and started treating it as information. Trends still mattered, but they no longer carried authority on their own. Confirmation replaced conviction. Flexibility replaced commitment. The market stabilized again, but in a new configuration. Direction still existed, but it had to be earned. Moves extended only when supported by broader agreement. Momentum became conditional instead of commanding. The deeper lesson was unavoidable. Momentum isn't power by itself. It's a reflection of belief. When belief is strong, momentum feels unstoppable. When belief fades, momentum becomes fragile, no matter how convincing it looks on paper. Understanding this reframes how trends should be read, not as guarantees, but as conversations between participants. Momentum works only as long as people agree to participate in it together. When that agreement breaks, momentum doesn't warn you. It simply stops showing up when you expect it most. And by the time everyone notices, The market has already learned to move without it. So what do you think? Are we still trusting momentum to lead us forward? Or has it already forgotten how to do that? The